Okay, so you know Raymond, right? Those guys who make suits and stuff. Well, they're actually called Raymond Lifestyle Limited now. Used to be Raymond Consumer Care Limited, but hey, whatever. They had this earnings call recently, and a bunch of you wanted the lowdown on it. So we got the transcript, and it's pretty dense, to be honest.
Yeah.
But that's why we're here.
Yeah, dense is one word for it. Lots of numbers, lots of jargon.
Exactly.
Yeah.
So we're going to try to make sense of it all for you today. Basically break down how their different businesses are doing, like textiles, apparel, all that. Plus, we'll look at, what they're saying about the future and also any risks they're worried about. Yep. Game
on. Let's do this.
All right. So first things first, Raymond Lifestyle. They it did okay revenue-wise, I guess, like a 2% increase. Not huge, but nothing either, right? 1796 crore rupees. But they were super quick to point out that the economy is like, not exactly a walk in the park.
Yeah, they were talking about global stuff too. Commodity prices going all over the place, supply chains still messed up, and then demand being all unpredictable in different markets. It's like trying to hit a moving target blindfolded.
And even here in India, it's not all sunshine and rainbows. Like,
yeah,
the GDP is supposed to grow around 6.5%, which is decent.
Yeah.
But it sounds like it could be even slower than that.
Right. And the thing that really matters for a company like Raymond is how much people are spending. And they were pretty clear that consumer spending is weak. Like, it's been an ongoing trend for a while now.
Makes sense, though, right? Inflation is still high and everything costs more. So people have less money for clothes and stuff. That's got to hurt a company like Raymond.
Definitely. And that brings us to their profitability, which, wasn't exactly stellar this quarter. Their earnings before interest, taxes, depreciation, and amortization, or EBITDA, was 221 crore rupees. And the margin, like the percentage of revenue they actually keep as profit, was only 12.3%. That's lower than last year.
So what's the deal with that? Why the drop?
Well, a few reasons, actually. One is that weak demand we talked about. If they're selling less stuff, their fixed costs, like, rent and all that, take a bigger bite out of their profits. They call that scale deleverage. Then there's the fact that they've been opening a ton of new stores, which obviously costs money upfront. And they've also been spending a lot more on advertising to support those new stores and new product launches. Plus, they mentioned something called adverse segment mix.
Adverse segment mix. What's that mean?
Basically, some parts of their business did worse than others, which dragged down the overall profitability.
Ah, I see. Okay, well, let's break it down then. They've got these different segments, right? Branded textile, branded apparel, garmenting, and high-value cotton shirting. So let's start with the OG, the one they're known for, branded textile.
All right, so branded textile, their revenue actually went down by 6%, dropped to 856 crore rupees from 909 crores last year, same quarter. And yeah, they're basically blaming it on that weak customer demand.
And their profit margin took a hit too, right?
Yeah, it went from 21.6% down to 18%. And again, they're saying it's mostly because of that scale deleverage thing. Lower sales mean those fixed costs have a bigger impact on each meter of fabric they sell.
So not great news for the textile side. What are they thinking going forward? Do they think things will pick up?
Well, they seem to be focusing on like higher end fabrics, trying to sell more premium stuff. They're basically saying this part of their business is going to grow slower, but they're aiming to keep those profit margins nice and high, around 20-21%. The good news is they did mention seeing some positive trends in bookings for next year, so maybe things are starting to look up a bit.
Fingers crossed, right? Yeah. Okay, so textile is kind of like the steady Eddie, maybe not a ton of growth, but decent profits. Now let's talk about branded apparel. This seems like where they're putting a lot of their energy. Definitely.
They're doing a lot of new stuff, launching new products, and really pushing their brand. And it seems to be working because their revenue in this segment actually went up 5% to 458 crore rupees.
Yeah, and they're not just sticking with the same old, same old. They're branching out in all sorts of new categories.
Right. They're doing ethnic wear with Ethnics by Raymond, which they launched a couple of years ago, and that's doing really well. They've got like 143 stores for that brand already. Then there's Sleep Z by Raymond for, pajamas and loungewear, basically. And just recently they launched Park Avenue men's innerwear, so like underwear and stuff, but they're positioning it as more premium, higher quality.
Yeah, they're really going for it, huh?
Yeah.
But all this expansion and new stuff, it's got to be costing them something, right?
Oh, yeah, it definitely is. Their profit margin for branded apparel took a hit. It's down to 9.6% from 13.9% last year. And they're saying it's because of all those investments they're making.
Right.
They opened 61 new stores just this past quarter, including 14 for Ethnics. That brings their total to 1,653 stores, which is insane. Plus, they opened 5 new made-to-measure outlets where you can get, like, custom-made clothes, and they're spending way more on advertising too.
Wow, that's a lot. So basically they're saying, hey, we're going to take a short-term hit on profits, but we're playing the long game here. We're going to grow this business big time.
Exactly. They see branded apparel as a major growth driver going forward. They think the profit margins will eventually settle around 13-14%. And they've got all these plans for their different brands. Like, they want to really push Raymond Ready to Wear, make it more widely available. They're revamping Color Plus, giving it a more sporty vibe with new collections. And they're turning Park Avenue into more of a hybrid brand with both formal and casual wear. They also mentioned strong bookings for next season, so that's encouraging. And they're super excited about Ethnics. They think it'll hit 100 crore rupees in revenue this year.
That's impressive for a relatively new brand. Okay, so branded apparel, lots of action there, lots of potential, but some growing pains too. All right, let's move on to garmenting. This is the part where they make clothes for other brands, right? Mostly international brands.
Yep, that's right. And this segment actually did really well in terms of revenue. They hit 309 crore rupees, up from 261 crores last year.
Oh, wow. So they're killing it in garmenting, huh?
Well, sort of. Their profit margin actually went down here, too. It's now at 7.8% compared to 11.3% last year.
So what's going on there? Why the lower profit if their revenue is up?
Well, it's kind of complicated. They signed on a bunch of new clients, like over 15 of them in the US, UK, and Europe, which is great for the future. But those new clients often start with orders for basic stuff like shirts, which don't have as high profit margins as, say, jackets or suits. So there's this like ramp up period where they're not making as much profit per garment. Plus, they got hit with higher shipping costs because of all the craziness happening in the Red Sea. And they're also spending money to train new workers because they're expanding their capacity big time.
Capacity expansion. What are they expanding?
They're trying to become a major player in suit manufacturing worldwide. They want to be the 3rd largest suit maker globally. And that involves like building new factories and training a whole bunch of new people. So it's a big investment.
Sounds ambitious. But it's cool that they're aiming high. And they do have an advantage here, Rick. Something about their supply chain.
Yeah, they keep talking about their vertically integrated supply chain. Basically, it means they control the whole process from making the fabric to producing the finished garment. And that gives them more control over quality and costs.
Ah, I see. So it's like they're not relying on other companies for different parts of the process. That makes sense. And they think this whole garmenting thing is going to be super profitable eventually, right?
Yeah, they're pretty confident about it. They think they'll be back to double-digit profit margins once those new client relationships mature and they get more efficient with their production.
Okay, cool. So garmenting, another one with lots of potential, but maybe we have to wait a bit to see the payoff. Now, what about that last segment? High-value cotton shirting. What's going on with that?
Well, this one's a bit of a downer, to be honest. Their revenue went down by 6%, just like branded textiles, down to 201 crore rupees from 214 crores last year, and their profit margin was 10.3%.
Oof. Not great. Did they say why it's doing so poorly?
They didn't go into a ton of detail, but it's probably the same story as with the other textile stuff. People just aren't spending as much on clothes right now.
Makes sense. Okay, so overall, we've got some bright spots and some not so bright spots. Let's shift gears and talk about their overall financial situation. They made a big deal about being debt-free again. That's got to be good, right?
It is. They said they have a net cash position of 61 crore rupees as of December. And they also improved their working capital, which basically means they're managing their cash flow better, like they're getting paid faster and they're not sitting on a ton of inventory.
So that's all good news. What about their outlook for the future? Are they expecting things to get better?
They seem pretty optimistic about next year, fiscal year 2026. They think demand will start picking up and they'll be back on a growth track. They're aiming for a 15% profit margin overall once they're done with all this expansion stuff. So they're thinking long term.
Long-term thinking, that's good. But they did mention some pressure on their margins, right? Like their gross profit margin went down a bit.
Yeah, they said it's mainly because of that scale deleverage thing again, and also because of the mix of products they're selling in the garmenting segment. Remember how those new clients are starting with lower margin items? But they were very clear that they haven't had to resort to like big discounts or anything to boost sales, which is a good sign. It means their brands are still strong. They also said that sales from their retailers to actual customers were healthy, so there is demand out there. The wedding season is just kind of weird this year, more spread out than usual, so that might be affecting things too.
Interesting. So maybe it's more about timing than anything else. Okay, so they think things will improve overall. But what about those specific segments? What kind of profit margins are they expecting for each one?
So for branded textiles, they think they can maintain those high margins around 20-21%. For branded apparel, they're aiming for 13-14%. And for garmenting, they're confident they'll get back to double-digit margins.
They also mentioned holding off on raising prices for textiles, right? That shows they're aware of how tough things are for consumers.
Totally. They usually increase prices by 1 or 2%, but they decided to skip it this time. They said they'll probably revisit it when the economy is doing better. And while they didn't give a specific target for their profit after tax or pay for next year, they did say they expect it to be much better in fiscal year 2026, thanks to that expected growth.
Okay, and what about that crazy ambitious goal they had set for themselves a while back? Remember that?
You mean the one about reaching 2,200 crore rupees in EBITDA by fiscal year 28?
Yeah, that one. Are they still sticking to that?
Well, they're still aiming for it, but they admitted that the timeline might be pushed back by a year or two. They said there have been too many unexpected challenges like the slowdown in rural demand and now the pressure on urban spending. But they're not giving up on it completely. They also clarified that their interest costs include some rental expenses and that their net interest expense is actually lower than what it looks like because they're making money from their investments.
So basically they're staying positive, but being realistic. Now let's talk about the scary stuff. What are some of the big risks they're worried about?
Well, obviously, that weak consumer spending is a big one, especially since they sell discretionary items, things people don't absolutely need. They're also concerned about inflation, the consumer price index being high and food prices being crazy. That eats into people's budgets and leaves them with less money for clothes. And then there's just the overall uncertainty in the economy, both here in India and globally. That could throw a wrench in their plans.
It's a tough time to be in the apparel business, that's for sure.
It is. They have to be really careful about how they manage all these investments they're making. They need to keep costs under control while also expanding and launching new things. And they need to make sure they're staying competitive in all their different product lines.
So it's a balancing act. But they seem to have a plan and they're being cautious.
That's right. They're not just blindly charging ahead. They're aware of the risks and they're trying to adapt.
All right, so to sum it all up for you folks listening, Raymond Lifestyle, they're facing some headwinds right now. The economy is tough, consumer spending is weak, but they're making strategic investments, they're expanding into new areas, they're trying to stay ahead of the curve, they're optimistic about the future, but they're also being realistic about the challenges.
Exactly. And they seem to be focused on building a strong and sustainable business for the long haul.
So that's the story. But now we want to hear from you. What do you think? Do you think Raymond Lifestyle is making the right moves? What are the biggest opportunities and the biggest threats they're facing? And what do you think are the most important things to watch besides just revenue and profit margins? Let us know your thoughts. Thanks for diving deep with us today.